Good day, traders, and welcome to the premium video newsletter for August 21st, 2013. We were expecting volatility, and we got it today, both to the upside and to the downside. Let's start off with the fundamentals and go from there. We saw a few interesting things happening today. The first report before the open was the U.S. sales of previously occupied U.S. homes, which surged in July to a seasonally adjusted annual rate of 5.39 million, approaching a healthy level for the first time since November of 2009. The spike in home sales shows housing continues to drive the economy. To give you some perspective, sales are 17.2% higher than 12 months ago. Further, negative retail news came out of Target retailer, which confirmed that the retail sector is in fact weak, and the future projections that are coming out of retailers are not confirming anything positive all the way through the end of the year and into next year. The retail sector is a very large part of the U.S. economy and can really have a strong impact on the broad market. The main announcement relating to the stock market came mid-session from the Feds, who confirmed that they are on target to slow down bond purchases by the end of the year. Many estimate that this may even begin as soon as September, when the Feds have enough employment data for the year. However, most traders and large hedge funds do not believe anything at all or anything significant will happen till December or possibly January of next year. Technically, the broad market opened and broke the short-term support level, but the Fed's announcement was nothing new and was everything that was already priced into the market and something we already knew going into the trading session. So after the announcement, the market rallied. Yesterday, the market did not show too much bearish indication, and today we are once again above the 50-day moving average. And I'm seeing volatility and momentum as buyers are coming in today. The next level is 1660, and unless the retail sector pulls us down, like it has been for the last few sessions, we will probably see us moving a bit higher in the next few days. Looking at the retail sector, the news out of Target only confirmed that Americans are not spending as much and are very cautious about the future of the economy. On one hand, this will keep the Feds from curbing the bond buying program. But on the other hand, it shows that this country is having a major problem right now, standing on its own 2 feet. Technically, the retail sector is right at the 50-day moving average. And from the looks of things, it's pulling us up today with the rest of the market. There's still a lot of correlation between this subsector and the broad market, and I'm seeing some funds accumulate today, so we are seeing some strength here by association, so to speak. There's a gap that is most likely going to be filled at the 81 level. So look for some upside movement in the broad market continuing upwards tomorrow. However, if we turn down again, this sector will have weak relative strength compared to the broad market, so keep an eye on that. The bond market was very interesting today. We have two interesting arguments, one technical and one fundamental. On a technical level, the bond market stayed near the bottom of the channel. If you recall, I stated a few days ago that if bonds don't bounce up too much and remain near the bottom of the channel, the odds are higher that we will go lower. And we are seeing that today. Now for the fundamental argument. Today we saw nothing new from the Feds. And everyone knows that as soon as Feds stop putting money into the market, the bond market is going to fall hard and fast. This is simple economics. So the question is why the bonds drop and the stock market rally after the minutes were announced today. The answer is the bonds tend to overreact, and we have to be mindful of that. So let's watch if we stay around these levels or move back to the upper range of the band, which is at the 127 level. The key will be if they bounce up or if they gravitate towards the bottom of the channel. It could be that bond market is just more sensitive right now than the stock market, but I found it very hard to understand why the stock market rallied to the highs right after the announcement today and the bond market dropped to the lows right after the minutes came out. Looking at the crude oil market, it seems like our analysis is working correctly. The market is coming down a bit, and if you notice, the daily range is almost as large as yesterday's, which suggests that extended selling is taking place. This is the time when buyers near the 106 to 108 level begin getting nervous, and selling starts feeding on itself. The next support area is the 102 area, and it's hard to determine at this time if we're going to try and test the highs again, or if the third time will be the last. Statistically, moving down after 3 tests of the high is over 65%. So let's see if the odds work in our favor and if we can break below the 102 area. The next market I want to look at is euro currency. I promised you yesterday that I would keep you posted, especially after the breakout we witnessed yesterday. If you recall, I mentioned that before I go long this breakout, I want to see more evidence of a real rally. And today, we did not see that. Ideally, I wanted to see us either break this high again and move higher, or, and this is important, I wanted to see if we can maintain a higher level. Similarly to how I'm watching bonds to the downside. I want to see if they bounce back up or stay down. It's the same situation, except with the bonds, it's to the downside, and here with the euro currency, it's to the upside. What we saw instead was a fairly volatile bounce back down. Not something I want to see at a point of a breakout. So as things stand right now, I'm leaning more towards the 132 area to the downside as the next swing for this market. The last currency for today I want to look at is the Australian dollar. It looks like we're done going up for now, and the main trend is once again taking over. This is a good example of how markets tend to revert back to the main trend, and once again we're going down for another round on the Aussie. The next level on the downside is the 88.5 area, and unless we hear something extremely positive from China, I believe we're headed there within the next week or so. Finally, I wanted to examine Netflix stock. It's a stock that many of you are watching, and I got a few emails yesterday asking me for my analysis of this company. The first thing I see is that there's very strong divergence between the last peak and this peak. Remember, the RSI is not a sensitive indicator, and for it to diverge takes a bit of work. So that's a big red flag that I'm seeing for more upside. The next thing I want to point out, and this is something I usually start my analysis with, is the monthly or weekly chart. This really shows me the fundamentals and the technicals and gives me a good background, and many traders, unfortunately, do not take the time to look at the long-term chart. Right now, I think we can move higher, but not that much higher. I would consider the 280 to 300 level as the next target. I would be cautious going long at these levels, and I would anticipate a correction to the 200 to 220 level before moving up significantly higher. There's no interesting setups for tonight. The markets are very range-bound right now due to the choppiness we saw during the session. I will update you tomorrow morning and earlier if I see something developing. Thanks and have a great night, everyone.